Hey traders from around the world, my name is Jerremy Alexander Newsome. I'm the CEO and co-owner of Real Life Trading. And I want to help you today with a very simple concept. It's a concept that's super foreign to a lot of people, and I think we can crush this video very, very quickly and just kind of open your eyes to what's out there. So this video, as you can see, is entitled Shorting Stock, the How. And in shorting stock, let me just really kind of quickly explain, I guess, if you will, as an example, how it works. But let's first hop over to a stock chart just to see the possibilities and the potential, and then I'll explain it to you. So hopping over here to Burlington Stores, Burlington Coat Factory, if you will. Today was a very, very decent gap down today. And this gap, as you can see from previous videos you might have stumbled across, is what's called a retest gap. So it's a black candle and it gapped down today. So I'm expecting Burlington to at some point retest. Now, it did trade to a target, which is the 200 simple moving average, this red line. So my expectation is for Burlington to retest, right, trade a little bit higher, and then at some point roll over. So my goal is to, let's say, be bearish on Burlington. Now, if you're trading a stock bearish, you really have many choices to you, but there are two most common choices. You can either short the stock, which means you're bearish, which means you're making money on it as it goes down, or you can buy puts. Those are really the two most common choices or options, if you will. So let me just explain, since I do a lot of day trading, and a lot of my day trading is based on stock plays, and I'm playing it bullish or bearish, shorting the stock or buying the stock. Let's explain then really quick Burlington Stores, Burlington Coat Factory, on what you could do. So let's hop over here into a 5-minute chart on Burlington, and just say, for example, you want to play this bearish today. So on a bearish trade, you saw a nice little bearish engulfing pattern, and you want to go bearish at 49.39, and then you place your stop right here at 50.36. So this is a potential trade that you placed today. Well, at 49.39, if you're day trading this particular stock, you would likely enter this as a stop limit order. So stop limit, and you would be selling, sell to open. So let me go ahead and place the stop. So the stop would actually be the price at which the stock gets triggered. So it's 49.39, and the limit is 49.39. So let me explain what this means exactly. So when you're selling to open, you are actually making money as the stock goes down. How is that possible? How can you make money on something that you do not even own? Well, here comes the explanation part. Let's say you have a friend, and your friend's name is Adam, and Adam has the new iPhone 7. So I'm making this video in June of 2015. I don't know if there's an iPhone 7 out there, but let's say he has it, okay? And you're like, oh my gosh, an iPhone 7, wow. So you say to Adam, hey Adam, can I borrow that iPhone 7? Well, it's in the box, never been used before, and he goes, you know what, man, sure, why not? I just need it back in about 2 or 3 months. And you're like, okay, cool, no worries. So you have his phone. You actually have the iPhone in your hand. So you take that iPhone and you put it on eBay for sale. Will somebody more than likely buy that iPhone from you on eBay? And the answer is yes, absolutely. I mean, there's someone who would probably pay a pretty hefty penny for that. So let's just say hypothetically you sell that phone on eBay for $700 cash. So that money comes into your account, $700 cash, you have it, you're like, yeah, sweet, okay, I sold this, but now there's a problem. What's the problem? Well, the problem is you did not own the iPhone to begin with. So what do you have to do? Well, now you have to go buy another iPhone. Let's say again, hypothetically, Best Buy comes out with an iPhone 7 for sale a month or a week later once you sold the iPhone on eBay. And that iPhone is selling for $600. So you go out and you buy the iPhone 7 from Best Buy, spend $600, and then you take the phone, which is still in the case, you give it back to your buddy Adam. Is everything square in this scenario? And the answer is yes. So let's explain it. Adam has his phone, he's happy. The guy on eBay that you sold the phone to, he's happy because he wanted a phone. If somebody wants to buy something from you, why wouldn't you sell it to them, right? So you have that. He's good. He has his phone. Adam has his phone. What do you have? You have your $100. So you're happy. So all three people in this scenario are actually happy. So if you're looking at the actual stock then, when you sell a stock to open, when you sell to open, you're selling something you do not actually own. You're borrowing those shares not from Adam this time, but from the broker that you're trading through. So maybe it's Charles Schwab, maybe it's E-Trade, whatever. You're borrowing the shares from the broker. As the stock goes down, the way you exit the trade is you buy to close, or also known as buy to cover. Either one, you can use either terminology, buy to close or buy to cover, but that's how you exit your position. That is you literally buying the shares from a broker and giving them back to your broker. So if you borrow shares from the broker and then you return the shares to the broker and you make a profit on the side, everything is good, everyone's happy, thumbs up. Now, obviously, what is the benefit of shorting stock? Well, you can make money as the stock goes down. What is the risk of shorting stock? Well, obviously, if the stock goes up, you can lose money. So you have to buy it for more than you sold it for. That's the risk. But if you can control your risk and you know how much to risk, which is your R unit at all times, you'll then see that risk mitigation is pretty easy in this scenario. So there's an example in Burlington Stores. Let's look at just one more really quickly. And this is a trade that I'm actually in personally. This is Southwest Airlines. And Southwest Airlines, I am in bearish as a swing trade. So here's the daily trade. So the daily trade, let's talk about this for just a moment. Without really using any moving averages, let's just make pure candlesticks. Very, very simple. Let's look at Southwest. So Southwest, huge bearish volume comes in. You have a retest gap, which is a strong gap. This is a strong, in my opinion, confirmation candle. Southwest goes a little bit lower and then actually retests. Then you get a small black candle, and I actually triggered in at 36.94 because the stock started making lower lows. Then I placed the stop right above here. So bearish entry, 36.94. Stop, 38.49. So I sold to open, well actually I bought puts, but hypothetically, let's say I sold to open shares, I would sell them at 36.94. I'm looking to buy those shares back, aka exit the trade, at 33.56 and then $32. So again, I did buy puts. So puts make money as the stock goes down. Buying puts is a bearish position. If you short a stock and the stock goes down, you want the stock to go down as well. And that is really and truly a very, very simplistic and easy way of explaining how you theoretically and technically do make money when shorting stock. Guys, it's a strategy I do every single day when I'm day trading. It's very profitable, very beneficial. I actually prefer shorting stock rather than buying stock. For my day trades, I do actually prefer to buy puts rather than short the stock. So hopefully this was a really quick explanation of how to make money in a bearish market with shorting the stock and just understanding how it works. If you have any questions, of course, feel free to email me anytime. Jerremy@reallifetrading.com. Our education is free. Ladies and gentlemen, our mission statement is to enrich lives and educate the world. I'll see you in our next video. And until then, remember, love life, live life, and trade it. Thanks.